Hey everyone, welcome to our channel where we talk about all things finance. Today, we're going to dive deep into the fractional reserve system of banks. This system plays a crucial role in the way our financial system works, but it's not very well understood by the general public. So, let's get started and break it down in simpler terms. But before that, please subscribe the channel for more updates. What is the fractional reserve system? The fractional reserve system is the basis for modern banking. It's a banking system in which banks keep only a fraction of their deposits in reserve and lend out the rest. This means that if you deposit $100 into a bank, the bank can keep a certain percentage of that, let's say 10%, in reserve, and lend out the other 90% to borrowers. The idea behind this system is to increase the money supply in the economy and promote economic growth. The fractional reserve system has a long history, dating back to the development of modern banking in Europe during the Middle Ages. In the early days of banking, goldsmiths and money changers would store their customers' gold and silver in their vaults for safekeeping. They would issue receipts for the stored gold and silver, which became known as banknotes. Over time, these banknotes began to circulate as a means of payment, and people realized they could use them instead of carrying around heavy bags of gold and silver. As the use of banknotes grew, banks began to realize that they could hold only a fraction of the gold and silver deposited by their customers as reserves and lend out the rest. This allowed them to earn interest on the loans and increase their profits. The fractional reserve system became more formalized in the 17th century with the development of the Bank of England, which was granted a monopoly on issuing banknotes in England. The Bank of England held a fractional reserve of gold and silver, and it was required to back up its banknotes with a certain amount of these precious metals. Over time, the use of banknotes and the fractional reserve system spread throughout Europe and eventually to the United States. In the U.S., the Federal Reserve Act of 1913 established the Federal Reserve System, which is the country's central bank and regulates the fractional reserve system. Today, the fractional reserve system is the basis of modern banking and is used by most countries around the world. How does it work? Let's say that John deposits $1,000 into his bank account. The bank keeps a certain percentage of that, say 10%, in reserve, which is $100, and lends out the remaining $900 to a borrower. Now, the borrower has $900 to spend, and they use that money to buy goods or services. The seller then deposits that $900 into their own bank account. The bank keeps 10% of that deposit in reserve, which is $90, and lends out the remaining $810 to another borrower. This process continues, and each time the bank lends out money, it creates new money in the economy. What are the advantages of this system? The fractional reserve system has several advantages. It allows banks to create credit and lend money to businesses and individuals, which promotes economic growth. It also allows for a more efficient use of capital, as banks can lend out more money than they have in reserves. This means that a larger pool of money is available for investment, which can lead to higher returns and greater economic growth. What are the risks? However, there are also risks associated with the fractional reserve system. Banks must keep enough reserves on hand to meet the demands of their depositors. If too many depositors want to withdraw their money at the same time, the bank may not have enough cash on hand to meet those demands. This can lead to a bank run, where depositors panic and withdraw their money from the bank, which can ultimately lead to the bank's failure. The creation of new money through credit creation increases the overall supply of money in the economy. When the supply of money increases faster than the supply of goods and services, the result is inflation. This happens because there is more money available to purchase the same amount of goods and services, which leads to a rise in prices. This is why the fractional reserve system can create inflation. So, there you have it. The fractional reserve system of banks. While this system has its advantages in promoting economic growth, it also comes with risks. It's important for individuals to be aware of how the system works and the potential risks involved. Thanks for watching.